Good morning. I'm Perianne Boring from the Chamber of Digital Commerce. Just to get started, we have an announcement to make for the attendees at SALT. This morning, our team at the Chamber of Digital Commerce unveiled a report called The Crypto Conundrum. Why won't the SEC approve a Bitcoin ETF? Our team at the Chamber spent the summer studying what has transpired between the investment industry's pursuit of and the SEC's unwillingness to bring a spot Bitcoin ETF to market. And really what we have found is that the SEC has moved the guardpost of what it's going to take to bring an ETF to market, and also that there's a larger political agenda underway. So if you'd like to receive a copy of the report, it's available on our website now at digitalchamber.org. I'd love just to open up the conversation with each of you as we talk about market structure, ETF being something that over 16 different issuers, some of which are some of the largest and most respected names in financial services, have all tried to bring one to market. Maybe, Brett, we can just start with you, just your thoughts on what would be the benefits of having a Bitcoin ETF?
So with ETFs, the amazing thing about them as a regulated product is that they allow for people to gain exposure to different traditional financial assets or non-traditional financial assets without needing to worry about constructing the index themselves or holding it themselves. So an example might be EEM, the MSCI Emerging Markets Index, is the underlying index of that ETF. It allows you to gain exposure to equities all across the world in Brazil, Korea, all by just buying a single thing that looks like a stock on Arca exchange. And for people who would like to gain exposure to Bitcoin, being able to do so by, again, buying a very simple ETF product would greatly enable people to invest in ways that wouldn't require them to actually learn about the custody of physical Bitcoin and worrying about security and all those sorts of things. Of course, it's been very difficult to get a spot Bitcoin ETF approved. And there's obviously a variety of reasons, and we can certainly go into them. But it would be a great boon for institutional investment into crypto to get exposure to it if there were an ETF that were approved.
Yeah, I think there's certainly an institutional case to make. And then, I think it's also important to recognize retail investors as well. Brett, you mentioned there are some new and novel risk related to investing in crypto assets, custody kind of being the most obvious one, where there is a lot of demand for retail investment in this space, and an ETF could mitigate some of those risks. We have futures Bitcoin ETFs, which is kind of interesting, and something we also delve into. Dave, given your experience in the futures market, can you just outline the difference between a spot and a futures Bitcoin product, and what are the difference between these two?
Yeah, sure. And we're happy to see at least the first step was taken and the approval of the futures-based ETFs hit the market. If I'm not mistaken, I think that the ProShares launch was the largest, the fastest ETF to get $1 billion in assets outstanding when it launched. So clearly the demand was there. There are some important differences, though, in thinking about the return profile of a futures ETF versus a cash Bitcoin product. The one that a lot of folks focus on is the fact that futures are not perpetual, at least not the ones that have been approved for use in this product. So you have to roll to the next contract when the contract that you're holding expires. And there are both financing costs and bid offer that you have to go through. So the investor holding the ETF asset, or at least the NAV of the ETF, is going to have to be reduced by those frictions. But there's a bigger issue, at least as traders, and I work at a firm that trades its own capital, that we're concerned about as well, which is there is a choke point in the creation of the ETF if you see a lot of demand happen very quickly. So the CME future, like all futures, appropriately has got position limits and capital requirements that are incumbent on whoever's buying the future. So the weight way an ETF gets created, somebody goes to the ETF issuer, has cash that they can wire in. The ETF issuer uses that cash as collateral and puts on the futures trade. What we saw in the first day was that demand continued. Pretty quickly, the FCM that was clearing the future contract for the issuer was going to run out of capacity at the CME. It's not a total disaster because the prospectus of the ETF allows cash to be held instead of 100% deployment to Bitcoin futures. But that's going to reduce the return profile for any investor that's seeking to get a Bitcoin beta-like return. So a cash ETF product is not going to have that same problem. You can go source Bitcoin from the entirety of the world's supply, and you're not going to run into that clearinghouse mechanism that could really constrain a successful futures ETF. So we're glad that it's out there. We trade it. We think it's a well-designed product for futures. We just think that there's a better way to express a Bitcoin exposure through the spot product.
Yeah, and just opening it up to the rest of the panel, of course, our opinions on why hasn't the SEC been comfortable with allowing a spot Bitcoin ETF to market? So,
well, I will say, being an eternal optimist, yet is the operative word.
Yeah,
your title is The Future of Market Structure, and in there you have all kinds of things: tokenization, derivatives trading. When you think about, even if it's a cash Bitcoin ETF, you're talking about a lot of idiosyncratic risk in one asset. It's important. It's the next step. These are all building blocks. But ultimately, you mentioned MSCI. I worked at Morgan Stanley. I was there. It took years. MSCI stands for Morgan Stanley Capital International. It was a hedge fund, an asset management company, Capital International, and Morgan Stanley, that took years to design something that was emerging markets investment vehicle. So I would say, I'm glad something has happened.
yeah,
The next step will be spot. And frankly, the most important thing, if this audience is an institutional audience, is a diversified ETF, substructures, if you will.
right. It'll pave the way for other more
Yes.
novel crypto
Yep.
ETF structures.
And I agree with the fact that it's a yet question.
Yeah.
Crypto is only 13 years old since Bitcoin was created. Securities have hundreds of years of development behind them. So we're working through some of the issues. The SEC has kind of defined market manipulation as one of the things they're focused on. That's something that's going to be hard to move very quickly. But ultimately, if you look at the long term, getting to that diversified ETF, getting to what's next, this is just a building block. It's the start of where the market could go.
On the market manipulation point, and this is a point that Don Wilson has made a lot of times in the past. Fair enough, but there's an oil ETF, and the price of oil is literally set by a cartel. So I think that the consistency there is a question worth asking.
Well, the one thing I will say on that, though, is my old industry, we paid billions of dollars to the regulators for, not doing everything 100% right. So you're right. People paid a lot of money for market manipulation.
Yeah, and we're against it, just for the record.
Of course. So what I would say for me, actually, there are three things that are not open to negotiation as far as they're concerned: market manipulation, AML, KYC, investor protection. So any business model, any product that takes that as a given will be a successful one.
Yeah, I think that's a great point. I mean, when it was the Winklevoss who attempted to get the first spot Bitcoin ETF, and in their denial, the SEC said market manipulation was their concern. But of course, we've seen a lot of maturation and institutionalization of the crypto markets since that first ETF was applied for in 2013. And the industry has addressed those issues, but there's also an argument that the SEC is holding this industry to a different standard than everybody else. And so that's part of what we're trying to bring awareness to, is the process in which has unveiled here. Moving on to regulation, I think as we talk about market structure, regulation is such an important factor in the future of market structure for the crypto space. In Washington, D.C., there's a lot going on from the public policy debates related to the oversight of digital assets. On one hand, you have the chairman at the SEC, Gary Gensler, who has said he believes pretty much everything is a security except Bitcoin and maybe one or two other tokens. And then CFTC Chair Benham has said that there's a lot of cryptocurrencies that are commodities. So we have some kind of like conflicting statements between the SEC and the CFTC. Opening this up to the discussion, given you guys all fit in different areas of the industry, how are your firms navigating the regulatory uncertainty today?
So as an exchange, our job is to figure out what tokens we want to list and then to offer them to our customers on our exchange. And a very difficult aspect of our role right now is the regulatory gray area of knowing what tokens we can be allowed to list. Because we're not a registered securities exchange. We are licensed as a MSB under FinCEN, and we can't offer unregistered securities to unaccredited investors, which means it's up to our company through our internal and external legal teams to determine whether tokens sort of satisfy the criteria to be a security or not. Which is why, as a company, we've been extremely conservative. We list, only a few dozen tokens compared to many of our competitors, which list sometimes an order of magnitude more, which puts us at a competitive disadvantage. But it's because we're concerned about the state of the regulatory regime for determining securities versus non-securities for tokens and where that's going to head. And of course, we're seeing some of this already start to play out with various enforcement actions. The thing that we want the most clarity from Washington for is the clear delineation of what is the registration process for a token, what sorts of registrations you need to have as an exchange to be able to offer those tokens to customers, and then what rules do you have to follow being an exchange that offers these kinds of tokens. And if we can get some clarity over that over the next, let's say, 1 to 3 years, the industry will be in a much better state and it'll be in a much better place for people to both issue new tokens and be able to offer them on exchanges.
We're building our business based on the fact that you will need licenses for a subset of tokens, currencies, commodities, or if they fit into those buckets, whether it's the CFTC or the SEC, they will ultimately create rules for different tokens, which would be securities, a subset of them. Currencies, Bitcoin, you could say, is a cryptocurrency. They've already said that, so that would be CFTC. So we are, again, agnostic. We're assuming that you will need, if you're going to operate in this asset class, which I think is an asset class that is Cambrian explosion of activity. It's one of the most exciting things that have happened in my career, and what made my career is finance globalizing. People forgot it took 3 decades for global finance to come up with regulatory frameworks. So the way we're building our business is to kind of understand the SEC will have a say, the CFTC will have a say, the OCC, all the C's will have a say in the US.
You got to learn your acronyms.
In the UK.
Yeah.
You come to DC, I'll give you an acronym tour.
You're right. And this is not the first time that the financial system has struggled with something like this. I think back to the aftermath of the financial crisis and the formation of Dodd-Frank. You had the CFTC and you had the SEC, both with very strong opinions about the regulation of derivatives back then, and the structure for trading swaps that was enacted was that you were going to have securities-based swaps that were going to be regulated by the SEC, and you had index-based swaps that were going to be regulated by the CFTC. I think at the time, Jamie Dimon joked that swaps traders were going to have an attorney and a psychiatrist sitting next to them to figure out which way they were going to book a trade. But that was a standards-based set of principles that you could love or hate, but was very clear and you could understand it. And I think moving to a structure like that and away from a facts and circumstances-based enforcement regime where you have to read a 75-page white paper and figure out who's running which nodes and how distributed a token might be is very complex to scale. So we would welcome that kind of initiative coming from the legislature or the regulators themselves.
Yeah, and I think that's one of the key points is the legislative branch really driving the how you classify these security or these assets. It's really hard to kind of have each individual company trying to figure out how they're going to navigate a course, and we can do that. There's a lot of rules you can point to. You can work with professional advisors, like you said, a psychiatrist and a legal counsel. It's you can work through that, but it's not going to be the most graceful experience. Having a clear roadmap or a clear direction from the legislative side is going to help a lot of companies really apply and really scale the business to what this could be.
So speaking of legislation, there's been over 60 bills introduced in US Congress, this Congress, related to digital assets, and many of them, or at least a handful of them, are very comprehensive and would address market structure in a number of different ways. Would love to get the panel's opinion of the different legislative proposals that we've seen. Which ones are the ones on your radar? Any that you're big proponents of or maybe opposed to? Where's your eye on the legislation today?
I'll start with, there's two kinds of bills that we are most interested in following their progress on. One is bills on stablecoins. Stablecoins are an incredibly important aspect of the digital market, the digital asset ecosystem. I mean, it's the thing that really powers DeFi and is one of the best use cases for crypto to be able to completely sort of replace the legacy financial system for being able to move dollars very easily and cheaply and quickly around to really any kind of to market or institution. And there's a couple bills proposed that would allow for different institutions, private, not just banks, to be able to get licensed as a stablecoin issuer, rules around the kinds of assets that must be held to be able to back those stablecoins, auditing requirements, different insurance requirements. So that's sort of one class. And the second class is, for example, the most recent Digital Commodity Consumer Protection Act, which is trying to allow for a regulated market under the CFTC to be able to trade Bitcoin and other tokens which are deemed to be digital commodities. Of course, the question of how you actually consider what is a digital commodity versus a digital security is still something of an open question, but something that we would be very excited for. Remember that Bitcoin and Ether, for example, are 55% of the total crypto market cap. That would be a huge benefit to consumers, to investors, to be able to get clear regulatory guidance for at least those two assets.
Any additional thoughts on the legislation?
It's a complicated process, of course, to introduce a bill and have it passed into law. We're excited that there are frameworks being put out. I think the initiative that Senators Lummis and Gillibrand took forward to put out a framework that maybe ultimately isn't going to be the final legislation, but it allows for both chambers to put their best ideas into it and kind of gives a vessel to move forward. I think we're excited to see that kind of bipartisan action to really tackle this as a national priority. And I think that if we get this right and we get legislation that is workable, provides the appropriate protections, and fits within the regulatory framework of the U.S., but still allows for innovation and experimentation, the U.S. is going to continue its leadership in financial markets, including new asset classes. And I really think that's what's at stake.
Yeah, no, I think that's very well said. We need guardrails, and I think, I think all of us can agree on basic principles of what we want to ensure and protect from a regulatory perspective, but it has to be flexible enough so companies can continue to innovate and iterate. That's what an innovation economy is all about, and that's absolutely key to success. Our team at the Chamber has worked behind the scenes on the Responsible Financial Innovation Act. That's the bill that Senators Lummis and Gillibrand introduced, a bipartisan effort. And then the Senate Ag Committee, which Brett mentioned, introduced a bill called the Digital Commodities Consumer Protection Act. And we support both of those bills, but they are very comprehensive in nature. They'll have to go through multiple committees. So it's not likely that either of these will be passed into law this Congress, but have put a significant stake in the ground in terms of moving that conversation forward. I wanted to circle back. Dave and Zoe, you both mentioned global principles and having a principles-based framework. We've been talking about the United States, but of course, this is a global ecosystem. Many of you are working with firms or your companies have operations overseas. So how do we get to that global perspective, I think the United States regulatory environment is unique because we have all these different stakeholders, all these different regulators that have jurisdiction in this space. Very different than, say, the UK, where you have kind of one point of contact with the FCA, or Singapore, where you really have a streamlined approach with the Monetary Authority of Singapore. And then who would put out these principles? Would it be the G7, the G20, or something else? Who is the appropriate authority to coalesce and actually get this done?
I think it's bottoms up first. In other words, what each sovereign nation, which is what's happening now. Yes, the FCA is one as opposed to 3 in the US, but they're just as militant of what they're saying. And frankly, I'm very impressed with how politicians, regulators around the globe are all coalescing around, we're not going to stifle innovation. The fact that the Republicans and the Democrats are spending a lot of their busy time looking at this asset class is a good thing. But they're all, whether you're talking to Singaporeans, whether you're talking to the UK, the Swiss, the continental Europeans, they're saying we're mindful, we respect the fact this is actually very important innovation, but the fiat on and off ramps, we're going to regulate you the way we regulate Barclays or Citigroup. Mm-hmm. And so I think the principles, as you've mentioned, it could be the G20, it could be the G7. It's where they all kind of meet and compare notes. What are the principles that we as an industry need to respect to be allowed to continue to innovate? So I think your efforts are very, very important. We as an industry need to be the adults in the room, not to, in the interest of innovating, kind of dance between the raindrops of what's right and what's wrong. And I think they need to keep an open mind as to how not to stifle the innovation. But I don't think it's unique to the US. Frankly, if anything, the Singaporeans began much more open to innovation, and they're now a lot more closed, frankly, because they feel investor protection is something they feel very strongly about, and we as an industry need to make them feel more comfortable.
Sure.
Yeah, for sure. I think it probably is the G20. I think the G20 was the body that set forth the global standards on derivatives regulation. As hard as that is, I actually think that's the easier part, is agreeing on a 2 or 3 page policy document that you get a lot of nations to sign on to. After that process, the actual rule writing and the mix of trying to be extraterritorial in the application of your home country's rules versus having equivalence with a like structure in a different country is where the real teeth gnashing occurs. And I think that was most prominent between the US and the UK on derivatives clearing rules and the way the standards would impact that market. But it took a few years, but it worked out, and you saw an equilibrium develop. But I think it takes a forward-thinking regulatory body or regulatory community to put the first straw man out there and say, we've read the principles. These are going to be the rules that govern our country. And then you let the other countries kind of react to that, shape it, and then go back and finalize things. So we're hopeful that it'll follow that process. But that is a long road. And
who do you think is most likely to serve that role?
I'm hoping it's the U.S. I'm hoping that some of these bills that are being written in Congress provide that catalyst and clarity for the regulatory community in the U.S. to use as the launch point. And I think we're well positioned to do it. Sam said at the beginning of the conference this morning that he's a lot more optimistic after having spent a lot of time in D.C., and so am I. I think we've got a real shot at it.
Great. So I think when we talk about market structure, it's also important to make the distinction between cryptocurrencies, this new asset class, and blockchain technology, which can be used to innovate market structure. I'd like to get perspective of the panel on how your firms are leveraging blockchain to make improvements to market structure in crypto.
especially in the area of collateral management for derivatives. I think blockchain offers an incredible solution for people to be able to very cheaply and quickly be able to settle collateral for the purposes of backstopping their account for collateral management. So an example might be, like, let's say you have a big futures position and the value of that position has gone down. You might get a margin call. Well, how do you actually meet a margin call? Well, you would have to wire funds through your bank. Maybe you call up your bank. It's a fairly large wire. Maybe you just missed the 4 p.m. cutoff. Maybe you type in the reference number wrong or whatever it is, and then you're screwed and you can't get your collateral there in time. Compare that to using a stablecoin, where you can, on the Solana network, in approximately 5 seconds, have your entire collateral moved from your wallet into an exchange or between two different exchanges very easily. So we think that this is a really useful area of application for blockchain, which is to settle instantly these different collateral movements across the ecosystem.
And FTX US currently has an application in front of the CFTC. Can you just talk a little bit about what you're building specifically and where that stands?
Sure. So just to briefly summarize, we have an application with the CFTC to allow for our futures clearinghouse to offer real-time, 24/7 direct-to-customer margin. So to break those up, one is that we want to do margin basically every 30 seconds instead of once or twice a day, like traditional CCPs. We want to operate 24/7 instead of only on weekdays. And lastly, we want to be able to take customers directly to the clearinghouse rather than relying on the necessity of intermediaries like FCMs. And we submitted this application back in December. We have lots of iteration with the staff basically every single day of the CFTC, and we're making great progress on it. And we're pretty excited to bring what is basically the accepted model internationally for cryptocurrency derivatives to the US, where such a small percentage of the world's crypto derivatives are currently trading.
Dave, you've had supportive comments of this approach. Why is that?
Well, first of all, I think it's a great way to look at a market as it exists today and say, how can we make this better? How do we make it more direct, more efficient? And I think the introduction of 24/7 trading is a march forward that the entire world's financial system is on, that's only going one direction. And it's hard. When we first started trading crypto a few years ago, it was really the first 24/7 market that we had interacted with. Yeah. And you've got to think of a very long list of things to get right, including like telling people not to shut down the data center for maintenance at 2:00 in the morning on Sunday, like they used to do. So I think the more we have the chance to exercise those muscles and get ready for what's coming, not just in crypto, but in a lot of other asset classes, the better. So we are very supportive of the FTX proposal. We think that the process that's going through of the comment period and iterating through with the staff is very healthy and a natural necessity when you're doing something that is really going to change the way the markets work. But it's something that we hope gets approved, and we're going to be supporters of when it's live in the market.
I am supportive of the FTX application and proposal because I actually am very impressed with Sam, the founder, and the vision that he has, that he's actually listening as well as talking, in the sense that when you listen between, the message, which is we have a dialogue with when we put in the application. So this 24/7 is an amazing innovation. That's why we're all very excited. The FX markets are not 24/7. So if you're going to do collateralization across the globe, you have to understand the new risks that you're creating by having half 24/7 and the other half the fiat. So as I said, I am very impressed that there are, Coinbase, they do understand. If you look at the very successful companies that are in this space, they're increasingly adults in the room, as I say, but visionary adults in the room.
Yeah, I agree with that. And I've had the opportunity to watch Sam testify a number of times, both in the House and the Senate. And as somebody who used to work on Capitol Hill for the member of the House Financial Services Committee, getting the CEOs of the the banks or traditional financial services companies to come and testify. You almost had to like negotiate with them to get them to come. They don't want to. But Sam's perspective is really different. He is happy to be a resource, and not only will he go, do the whole thing of testifying, but you see him in the hallways too, of going and having those personal interactions to help educate people. And he's talked about that. It's because he does see that this technology can democratize access to things in the financial services space that other people haven't been able to reach before. And it's that broader vision that I think is so needed in the financial services space today. So in addition to having Brett as also an amazing spokesperson for our industry as well. Maybe just moving to the institutional side. So that certainly touches on kind of the retail aspect of this, but institutions are also a critical component of democratizing access to financial services by increasing the adoption of blockchain technology and digital assets. I feel like we're starting to get more institutional involvement. There's certainly a lot of interest from the institutions. So you've spent your entire career in the institutional space, and this is something you've put a lot of your personal time into as well. What is your message to the institutions, and what else do you think needs to be done in order to make sure they have the ability to engage in this technology ecosystem?
Well, all of these institutional prospective investors used to be our clients at Morgan Stanley, and I'm very clear of their needs. I think zero asset allocation to this space is the wrong answer. More than 10% is also the wrong answer. This is a nascent industry. It's very early. And ironically, even if they put 1% of, some of those are pension funds, ironically, they want to see actually a much more robust regulatory framework to come in here. So I actually feel all those discussions we have with regulators, if we come to a fruitful end, you're going to see a lot of money coming into that space. Without that, they won't. So I'm very clear that the smart money is, if you look at all the institutional clients that are looking at this, at the moment, it's not quite pencils down because we are in the middle of crypto winter. And they are worried about 98% of their portfolio, the 60-40 portfolio, they need to spend a lot of time on, looking at the macro picture of the world. But they're being very thoughtful about its temporary pencils down, but they're taking this space very, very seriously. There are $200 trillion worth of public securities. If 1% comes into that, you're talking about $2 trillion of new money coming in. This money is only going to come in, as I said, if we finish those conversations with global regulators.
It used to be that you could trade equities in isolation. There were people that were focused on equities. They traded equities. You could trade credit in isolation. You could trade options in isolation. And now it's really impossible to trade one of those asset classes without having a meaningful understanding of what's happening in the other two. You have to be full capital structure. You have to understand relative value across assets. And you've got to use that data to inform your trading strategies in any of them. And at least in our trading, we're seeing the same thing, the same integration across markets happen with crypto and traditional markets. So which market is leading and which market is lagging? When there's an economic release, how does that impact the price of crypto assets versus traditional assets? I think for institutional investors that are trying to trade the 98%, not having a stake and the analytics capabilities to understand what's happening in the crypto market is going to become a bigger and bigger blind spot. And I think that in addition to the maturation of the custody and regulatory frameworks that they need, accounting, they're going to need it for their alpha in the traditional business as well.
Absolutely.
And you're beginning to see that maturity in the space. The building out of the regulatory frameworks, we see it moving. We also see kind of the infrastructure, the custody, how exchanges operate. We've now had a number of years to learn and to build the confidence of the market in how we operate and how the more mature players in the space operate. So it builds that confidence to allocate 2, 3, 4, 5% of your portfolio to crypto assets and allows you to diversify in that way. So see a lot of movement in that space, given the maturity that people are seeing. That regulatory aspect is really kind of that last impediment to work through to kind of figure out how do you meaningfully engage.
Well, with that, we'll conclude today's conversation. I'll be heading back to DC tomorrow to get back on encouraging our policymakers to move the policy forward so we can support more adoption of this technology. Brett, Zoe, Dave, and Mike, thank you each for joining me for this discussion. Please join me in thanking our presenters.
Thank you.